How did you make sense of the two conflicting data points on the jobs front this morning?
Yeah, I mean, overall, I think you have to be careful reading too much into any one report. I think the reports that we saw this morning, the jobs report, the ISM services data, I think there was, a good bit of noise in that. On the one hand, the ISM, the services data suggested that employers actually many employers actually reduced employment, and that number fell quite a bit, down into deeply recessionary levels. But obviously, the headline number on the actual payrolls report presented a very different picture, was a pretty resilient labor market and economy. So I think you just kind of have to, take all of this with a grain of salt, and I think that's what the markets are doing. They're not really reacting that much to these reports this morning.
Well, there are the reports this morning, and then there's more data next week. And if you think about the path of inflation, there have been a lot of conflicting signals. You think about wages, you think about oil prices. How closely are you reading the numbers next week?
Yeah, no, I mean, I definitely think, next, obviously markets are going to care about the inflation reports, any of the inflation reports. I think what the Federal Reserve cares about when they look at it is, are we coming down into levels that are more consistent with the Federal Reserve's mandate? And we've been saying the Federal Reserve probably will be okay with inflation on a year-over-year basis, somewhere below, they probably need it to be somewhere below 3% just for the optics of it to start cutting rates. I think we've seen quarterly inflation rates, especially in the core PCE measure, which the Fed cares a lot about. They've gotten into that 2-point-something range, but we're kind of still waiting for that year-over-year rate to get down there. Overall, we kind of think the Fed probably starts to cut closer to the middle of next year. But certainly March is in play, as the markets have suggested. But a lot's already priced into the market at this point.
This morning, we had U.S. Treasury Secretary Janet Yellen make comments after that job report saying, the soft landing is here. She did kind of caveat saying, we'll see what happens for the rest of the year. Do you agree that, much of that hard work, that slowdown has already happened? What's your base case for how things play out in 24?
Yeah, I mean, so we've been calling our base case a, quote, soft-ish landing. Ultimately, we think if you do get any sort of, mild recession or economic stagnation, it's going to be, not comparable to a 2008 recessionary experience or slowing experience or even a pandemic experience. And ultimately, the unemployment rate, we don't expect to rise in that kind of manner either. But nevertheless, we think next year is going to feel a lot different than this year. We do expect growth to stagnate. I think the things that drove the outperformance and the resilience in the U.S. economy this year, and just including fiscal policy that was still sort of sloshing around the economy via excess real savings balances, those types of things are normalizing. And when those things do normalize, we're still ultimately left with tight monetary policy, even though financial conditions have eased somewhat. So, we think growth does, stagnate in the United States next year. That's going to feel a lot different than the 2.5% growth we got this year. Unemployment rates will probably rise. In that kind of environment, the Federal Reserve, can start to cut interest rates.